McDonald's sells more than 75 hamburgers every single second of every single day, somewhere on Earth. And despite that almost incomprehensible volume of burgers, fries, and milkshakes, the actual food business is not where the company makes the majority of its operating income. A former McDonald's executive, and later the company's own longtime finance chief, once said the quiet part out loud. McDonald's isn't really in the business of selling hamburgers. It's in the real estate business. So here's the real question this video is actually about. How does one of the most famous fast food companies on the planet make more money from real estate than from the burgers with its name on the building? This isn't a fringe theory. It's documented in McDonald's own public financial filings, the same documents publicly traded companies are legally required to file with regulators every year. McDonald's owns or leases a truly staggering amount of real estate, reportedly well over 30,000 pieces of property around the world tied to its restaurants. And every single year, in its own annual report, the company breaks out exactly how much revenue comes from franchised restaurant rent and fees, separate from company-operated restaurant sales. That rental and franchise fee income has consistently represented a very large share of the company's total operating income, in some years reportedly the majority of it. That's not a rumor pieced together from anonymous sources. That's a number McDonald's chooses to report to its own shareholders every single year. Now, the easy explanation is franchising just means franchisees pay a fee and McDonald's collects it. Simple as that. And sure, that's technically true. But that explanation alone doesn't fully hold up because plenty of franchise businesses exist, hotels, gyms, other fast food chains, that primarily collect a percentage of sales as their franchise fee and don't necessarily own the underlying land and building the franchisee operates on at all. If McDonald's franchise model worked that simply, it would look basically identical to every other major franchise brand's financial structure. It doesn't. McDonald's financial structure is meaningfully different in a specific and deliberate way from most other franchise businesses you could name. Here's the piece almost nobody explains clearly. In the vast majority of McDonald's franchise deals, McDonald's the corporation, not the franchisee, owns or holds a long-term lease on the actual land and building the restaurant sits on. The franchisee then pays McDonald's rent for that property, on top of an initial franchise fee and an ongoing royalty based on a percentage of sales. So a single franchisee in a single restaurant is typically paying McDonald's corporate through at least 3 separate financial channels at once: the franchise fee, the sales royalty, and the property rent. Which means McDonald's isn't just collecting a cut of burger sales. It's collecting rent on some of the most carefully chosen commercial real estate in the world from a tenant, the franchisee, who is contractually and financially locked into staying in that exact location, running that exact business for the life of the franchise agreement. And this is where it gets genuinely more interesting, because McDonald's doesn't select that real estate the way an ordinary restaurant owner might. There's an entire internal team, effectively functioning like a specialized real estate investment operation, whose full-time job is evaluating potential restaurant locations using criteria that go far beyond, is this a good spot for a burger joint? McDonald's real estate team has historically evaluated potential sites using detailed analysis of traffic patterns, population density, growth trajectories, visibility, and accessibility. The exact same fundamentals a commercial real estate investor would use to evaluate a property's long-term appreciation potential, not just its short-term suitability for selling food. The company has, at times, been so deliberate about property selection that industry analysts have described its real estate arm as functioning less like a support division for a restaurant chain and more like an independent, highly disciplined property investment firm that happens to lease almost all of its holdings to a single, captive tenant type. Which raises the real question this video is actually about. If the real estate itself is being managed with that level of investment discipline, how much of the company's total value actually comes from the land and buildings versus the burgers being sold inside them? Here's the mechanism, named plainly. It's a structure sometimes described using the phrase McDonald's is a real estate company that sells burgers to pay the rent. And while that's a simplification, the underlying financial logic behind it is genuinely sound. By owning or controlling the land beneath thousands of high-traffic, carefully selected commercial locations, and leasing that land specifically to franchisees who are contractually committed to running a McDonald's on it for years or decades. The company has built something closer to a large-scale commercial property portfolio with an unusually reliable, built-in tenant base. One that can't simply move out or switch to paying a lower rent somewhere else without walking away from the entire franchise relationship itself. So the reframe here is this. The Golden Arches were never purely a food brand sign. They're functioning, financially, as something closer to the signage on a very well-managed, very well-located commercial real estate portfolio. One that happens to have burgers sold underneath it as the mechanism that keeps the rent flowing in reliably, month after month, for decades at a time. And once you see it this way, a lot of McDonald's specific business decisions start making a different kind of sense. The company's famously careful site selection process for new locations. Its historical willingness to essentially teach franchisees a rigorous operational playbook rather than leaving success to chance, because a struggling franchisee is a rent-paying tenant at risk of default. Its consistent long-term focus on prime, high-visibility corners in growing areas, exactly where you'd expect a sophisticated real estate investor, not a fast food executive, to want to plan a flag decades before an area fully develops. So here's the number. McDonald's has reported franchised margins on rental and fee income running dramatically higher than the margins on company-operated restaurant sales, commonly cited in the range of similarly high percentage margins on franchise revenue, compared to the razor-thin single-digit to low double-digit margins typical of company-operated restaurant food sales after accounting for labor, ingredients, and overhead. Selling a burger involves buying beef, paying a cashier, running a kitchen, and managing spoilage. Collecting rent on land you already own from a tenant contractually obligated to keep paying it involves comparatively minimal ongoing cost once the property is acquired and leased. That difference in margin, multiplied across tens of thousands of locations, is the real engine behind why real estate and franchise income can represent such an outsized share of total operating profit. Now, if the margin gap between selling burgers and collecting rent sounds significant, wait until you see what this same real estate logic does to how McDonald's actually approaches new markets and new locations. Because the property strategy isn't just about squeezing more margin out of existing restaurants. It's about a much longer-term bet that most people never think to ask about at all. Here's the layer most people miss completely. When McDonald's real estate team selects a location, they're frequently not just evaluating whether that spot works today. They're betting on where an area is headed over the next 10, 20, even 30 years, placing corners in growth corridors before the surrounding development fully arrives. The same long-horizon strategy a patient commercial property investor uses, not the short-term thinking of a company just trying to sell today's lunch rush. As the surrounding area develops, traffic increases, and property values rise, the land underneath that restaurant can appreciate substantially, independent of whether burger sales at that specific location ever dramatically change at all. Which means a McDonald's location isn't just generating rental income and royalty income today. It's also functioning as a long-term real estate asset sitting on the company's books, potentially appreciating in value for decades, largely independent of the burger business that gave the company the excuse to acquire that specific corner of land in the first place. The burgers got McDonald's in the door. The real estate is what the company actually held on to. Here's why this matters beyond just understanding one company's balance sheet. This exact strategy, using a consumer-facing brand as the mechanism to acquire and control valuable real estate, then monetizing the property itself as much or more than the actual product sold on it, shows up across a surprisingly wide range of industries once you know to look for it. Some major gas station chains make more from the land and convenience store lease structures than fuel margins alone. Certain shopping mall anchor tenants have historically been offered such favorable lease terms specifically because their presence drives foot traffic that makes the surrounding real estate more valuable to lease out to everyone else. And franchising itself, as a broader business model, frequently works partly for this exact reason. It allows a brand to expand its physical footprint and market presence using someone else's capital and someone else's daily operational labor, while the parent company retains ownership or long-term control of the most valuable, appreciating asset in the entire arrangement, the underlying real estate itself. The franchisee takes on the operational risk of running a restaurant. The parent company, in McDonald's specific case, retains the property risk and, far more importantly, the property upside. And this is where the story gets genuinely counterintuitive, because it means franchisees, in a very real financial sense, are not just McDonald's customers or business partners in the traditional sense. They're functioning as long-term, contractually locked-in tenants, taking on daily operational risk in exchange for the right to run a business on land that McDonald's corporate itself is quietly, patiently accumulating value from in the background, separate from how well any single location's burger sales happen to perform in any given year. So here's the full mechanism, all the way through. McDonald's built one of the most recognizable consumer food brands on the planet and used that brand's expansion, funded largely through franchisee capital, as the engine to acquire an enormous, carefully selected portfolio of high-traffic commercial real estate. Franchisees pay rent, franchise fees, and sales royalties, all flowing back to the parent company, with the rental and fee income carrying dramatically higher margins than the food business itself. And underneath all of it, the underlying land quietly appreciates over decades, a long-term asset largely decoupled from the day-to-day burger business that gave the company its public identity in the first place. The burgers built the brand. The real estate built the balance sheet. Which leaves an interesting question worth sitting with. As consumer habits shift toward delivery, ghost kitchens, and smaller footprint locations that need less prime, high-visibility real estate than a traditional drive-through restaurant historically required, does this decades-old real estate strategy start to weaken? Or does a company with this much accumulated property expertise simply redirect that same discipline toward an entirely new category of real estate, built around wherever consumer behavior is actually heading next? This is exactly the kind of thing this channel exists to unpack, not the surface-level fact that McDonald's franchises restaurants, but the actual, decades-long financial architecture quietly running underneath one of the most familiar brands on earth. If you want to keep seeing the real mechanics behind the businesses you interact with every day, subscribe. Because next up is a store almost everyone has gotten lost in at least once. And it turns out that confusion isn't bad design at all. It's one of the most deliberately engineered retail layouts in the entire world, built specifically to keep you inside for far longer than you ever planned. Next time you drive past a McDonald's on a busy corner in a growing neighborhood, you're not just looking at a burger restaurant. You're looking at a carefully selected piece of real estate that happens to sell burgers on a corner someone at the company decided, years in advance, was worth owning.